Excellent. This is really a pleasant event because Ram is one of my favorite guys in Silicon Valley, and Ram is really one of the nicest guys in Silicon Valley. And if you do what I call the Niceness Success Index, where you take the measure of a guy's niceness and you raise it by the exponent of the guy's success, all right, Ram has got one of the highest values here in Silicon Valley. And it's really a joy to know that you can be a nice guy and be so successful. And, you know, the thing that's really remarkable in part about your career, Ram, is you have an extraordinary wealth of experience going from epochal company, magnificently successful company, to magnificently successful company. You were at Netscape in the early days. You were at Amazon at the early days. You were at Google as an early investor and with the company in the early days. You can't miss, Ram, all right? You can't do anything wrong. It's stunning. And with that kind of background, let me just start off with a really broad question. What are the most important lessons you've learned from the experience you've had at these companies about entrepreneurship, management, and board-level governance? Just in general.
Thank you, Joe. I think my mother would have loved to hear that.
Well, give me her number. I'll call her and I'll let her know.
She's turning in her grave, but
I'll still call her and let her know.
But in all seriousness, I think luck has a lot to play in these kinds of choices that you make. But I did find some great founders along the way and jumped ahead of the parade and jumped into these companies at the right time. So I can't claim credit for every one of these successes, but it's nice when you have them back to back. At Netscape, which was one of the early breakout companies on the internet, and this was before ad models were discovered and so forth, I think that the key learnings for me were really that it was the first company that had downloaded software. It was always packaged software before then. It was the first company that tried to download the software on the internet with the Netscape Navigator, and it became a success because you could instantly get it to millions of people, and that was because the Ethernet was there and PCs were there and everyone could actually download a piece of software as long as it was not a very large file. And that was one big innovation. The other was, and this sort of happened almost by happenstance, when you are an internet company, you're global from day one, whether you like it or not. You are operating in at least 30, 40, 50 countries, especially if your software is more generic of a platform nature, unless you're like an e-commerce company, in which case you have to go geography by geography. But if you're something else, people will start using it in areas you never intended it for your software to be used. And that's what happened to Netscape. The third is product cycles. You learn to work in 6-month or 3-month product cycles where you have to do very rapid iterations and updates. And that was another key learning of Netscape. Because before that, I came out of the packaged software world where we had 2-year product cycles, and we had to throw that out. It had to be really quick. At Amazon, I sold my company to Amazon and worked for Bezos. It was one of the first acquisitions that Amazon made after they went public. And he made me a Section 16B officer. I was the oldest guy on his staff at the time in 1998. When I was 43 years old, and he was a young 30-year-old CEO of running his company. Jeff is now over 50, so he's been running the company for 25 years, or 22 years. The learning from that was, one day he came to me and he said, "You're below budget." And I said, "But Jeff, we're losing money, and you know, I got to worry about this." He said, "That's not your problem, that's my problem." I said, Go spend and get more traffic in through the front door because I want more customers, more users, more scale. So the learning there was he was very smart about how to raise money in a way in which it was non-dilutive. At one point, Amazon had more debt than the national debt of Brazil, but it's come out better than Brazil. And the second learning from working for Jeff was it's not just about big vision and he wanted to get big quick. It was also about you cannot have scale without good execution, because scale without good execution is meaningless. And for him, scale meant lots and lots of data on his users, lots of ways in which he was going to continue to grow the value per user, the life cycle value per user. And those continue to be the reasons why they have a long-term view and the market still believes in them. And of course, along the way, he ended up building other businesses that are actually producing greater contribution margin, which were not predicted at the time, but turned out to be great side benefits. At Google, I think it was about hiring. At Amazon, we didn't get hiring quite right because there was a lot of turnover. It was one of those companies that succeeded despite having a lot of turnover. Most companies don't actually succeed when they have that much turnover, but they did, and they still succeeded, again, because of a very cerebral, far-thinking founder. At Google, it was always about hiring. From the day the company started, for the first year, the founders had only 8 employees, and I said, why only 8 employees? He said, well, we can't find anybody good. I said, there's certainly a lot of good people, more than 8 good people that you can find. He said, no, we can't find the programmers we need that are of the quality that we need. So we're going to go back and teach classes at Stanford and try to hire the best students. And so that way they went and found
that model doesn't scale very well.
I know. So, but it did keep the burn rate down at a time when we just had users and hadn't turned on revenue. So then came the VCs, and we raised money in the bubble. We were lucky to do that. And they got very antsy because they had paid a very high price to get into this company with no revenue, but with a lot of users. And so the founders were like, we're in no hurry to focus on revenue because we're really just focused on users. And we want to make our users very happy. So, and this is something that also Amazon did later on very well, was to keep the users happy. But that's what Google focused on, and it ultimately paid off because to this day, the brand value is in the fact that the users go do the Google search, and to them, that's the truth machine where they still, even though there's a lot more spam on the internet and many ways to game linking and so forth, they've continued to try to get ahead of this and keep the product the best among all the others that are out there. So, and again, it's a case of scaling very, very methodically. Certainly in the early days, the scale happened very thoughtfully. And they didn't say, we want to go out and build a platform, because a platform without users is meaningless. So companies that start off saying, well, we're going to be a platform for this or a platform for that, doesn't mean anything, because if they don't have users, they don't really have any way to make that a meaningful platform. So the search business as a platform ultimately resulting in taking the next contiguous areas. So you don't go grab the next hill unless you've taken the first one. And the first one for them was search, produces a lot of profit, and then allows them to go after all the contiguous areas that they've since gone after successfully. I think that's really the learning from Google and sitting there and watching. But in the end, it's about great founders. And I was happy to have a ringside seat to each of these experiences.
Right, so basically it's betting on the people as a practical matter.
Absolutely.
Now, the situation that we're in today is really sort of sitting at the cusp of a potential change in eras in Silicon Valley. There's a perspective that we're now past the age of the unicorn. The IPO window is either totally shut or open only a small crack. Unclear where the market's going to go. Valuations appear to be coming down. In the negotiations between VCs and entrepreneurs, increasing power and valuation metrics are moving in the direction of the VCs rather than the entrepreneurs. And there's a concern that we're going to be heading into the part of the cycle where it becomes very hard raising cash. From your perspective, what kind of advice would you give entrepreneurs and board members sitting at this potential cusp where the degree of uncertainty is much larger today than it was 4 or 5 months ago when we were actually planning this conference?
Well, I think everything you just said is true. That said, these are business cycles, and we've had them before, and we'll have them again. So if you're building a good long-term business, I would not worry about this short-term blip, other than, of course, if you happen to be needing money at this time, you're going to end up with a little more dilution than you had perhaps bargained for. So if the business is either got a lot of users or you're near cash positive, then you're more likely to be able to raise money, perhaps at a lower price, but still be able to raise money. If you don't have either of those metrics going for you, narrowing net burn and or nice growth of users and or top line, if you don't have those two going for you, then I think it'll just be delayed longer. It depends on the circumstances, depends on the market space. You may have to kiss a lot of frogs before you find a prince.
So taking a step back, every venture capitalist currently in the market has to have their view as to what capital market conditions are going to be like over the next 6 to 12 months. Because otherwise, you can't decide how much to pay for a particular company. You can't decide whether this is the kind of bet that you want to make. And every time that you invest in a company, you're also looking at the company's potential capital requirements over time. So you've got to have your own assessment as to whether this is going to be a fundable company at the next round, especially if the next round isn't the one that gets it to IPO. I'm sorry, to cash flow positive. So looking at earlier stage deals. What's your perspective of what the horizon for fundraising looks like the next 6 to 12 months?
I think the fundraising environment will remain tight till there is either a series of successful exits / acquisitions. Today, the press was, there was a rumor that Slack was being looked at by Microsoft, but they turned it down because the price was $8 billion. I mean, it was reported by TechCrunch this morning. We don't know whether it's true or not, but they are going to now go raise money. They'll probably raise it at a discount to that $8 billion price, if in fact that was the price they were seeking. But it's still a company that can raise money. I think people are going to look for a marquee IPO. That would be an exit that everybody gets comfortable around. That could be Uber. I mean, they've waited a long time. They have great metrics. It could be the next $100, $200 billion company. Whether they do it this year or next year is really up to the company and whether they feel they're bolted down and ready to go out. But that will change sentiment in terms of funding. But otherwise, I think it would be good to be frugal with, there comes a point in the life of every company where either equity is pricier than cash or cash is pricier than equity. Well, we're now back to a point where cash is more expensive than equity. So companies will end up giving up a little more equity for cash if they need the cash.
And the whole unicorn phenomenon has really been very, very popular in the press. And over the last several months, we've seen many companies do their IPOs as down rounds, where in effect you raise money at a valuation of $6 billion, and you go out and the company's got a valuation of $3-4 billion.
Right.
Put aside the ratchets and the other preferences, we'll get to that in a second. From your perspective, was that a signal that private market valuations were really getting ahead of the reality in the marketplace?
I think the private valuations have been higher than the public valuations for some time now. I would say perhaps over the last 18 months to 2 years. They've slowly run up and run ahead of the appetite in the public markets. That has gotten ratcheted back effectively somewhere starting in Q4, but now almost slowing down to a crawl in Q1. Very few financings are getting done at prices that people want. So it is a funder's market or a sort of a buyer's market. And I do think that for the companies that did go public, whether it's a Square or a Hortonworks, or you pick your company, whether it's consumer or enterprise, they've all had to to deal with the public markets giving them a haircut.
Absolutely. And when you see us in Silicon Valley valuing companies at numbers that are higher than what you can take the company public at, do you view that as a sustainable market equilibrium?
No, it's not sustainable. And I think it'll actually cause some of the PE guys that have been investing, or the late stage public-private guys from, the Fidelities of the world, to perhaps, either pull back a little bit or be much more cautious about investing at these high prices.
Well, this, it's interesting, Ram. This raises a question, that we hadn't
That
talked
said,
about.
Snapchat did $175 million today,
Right.
or yesterday, announced yesterday, with Fidelity at a $16 billion price tag.
Right, and that apparently is flat relative to their last round.
But it's still a great price.
It's a magnificent price, and not only is it a magnificent price, it's my understanding that that's common.
Right.
And that Snapchat is such a strong business that the cash that it's raising, they're actually selling plain vanilla common, and they're not selling any preferred. And in this environment, in order for you to be able to maintain your valuation, that's actually, I think, a pretty strong endorsement of how well the company's doing, given the fact that it may have been out over its skis as a practical matter in the recent past. Are there any particular lessons that you would take from this experience for members of boards of directors of privately held companies? How should they be thinking about cash flow demands, about their capital structure? Should they be looking more at raising debt? What would you be looking at from a board of directors perspective?
Well, raising debt has its own problems. I think there's been instances in the recent past where some of the debt holders have gotten pretty aggressive too. Especially when a company starts to break its covenants on the debt. They've gotten aggressive even though they don't have a way to actually generate value. They'd like to take the company over, maybe liquidate it. A couple of instances where companies have been lost to debt holders, which has never happened in the past.
This is new. This is a new phenomenon. Typically companies in the Valley, to the extent that they had debt, the debt was typically a small enough amount on the balance sheet that you could always negotiate the problems away. If, on the other hand, your leverage becomes sufficiently large relative to your capitalization, you've got big enough of a problem, then the bank can basically take a gun, hold it to your head, pull the trigger, and sell you for body parts. And if your other backers aren't willing to step in and take the gun out of the bank's hands, you're going to be shot. Is that about right?
Yeah, that's happening in a few instances. It's not a widespread phenomena yet, so I wouldn't start a panic here, but it is happened in a couple of instances, and it's worth noting that banks are starting to flex their muscles so that they could get at least pennies on the dollar, which means the investors get nothing at that point, and the founders get obviously even less than nothing. The answer to your question as far as what should directors of young private companies be doing, I think the answer is be judicious in the use of cash. I would certainly be looking closely at cash burn, but not necessarily throttling growth. It's a fine balance between using the cash for growth and using it, for example, to go get a new building in San Francisco and spending $2 million to outfit the building. If you've got...
You're not a big fan of that, I take it.
I am not.
There
So
you go.
out with the Herman Miller chairs and maybe find some used furniture. So I think those sorts of things, little things like that, make a difference in lowering cash burn. And so boards need to be looking at that. They also need to be looking at ways in which companies can raise additional money if they need to raise it in creative ways. They can find overseas sources of funding. They can also find second and third tier investors who are perhaps more willing to invest in the company, even if you feel like you want to be partnered with other marquee investors. Maybe that may not be possible, depending on how that company looks to the other investors coming in.
Well, one of the things that I've been advising, many of the companies I work with in the calls is have a look at your financials and sit down with your team and say, assume that the one objective of this company is to get to cash flow positive. because if you're at cash flow positive, you're no longer at the mercy of the capital markets. The window can stay shut for as long as you want, but if you're cash flow positive, you can pay the rent, you can pay the salaries, and you can make it, you can hibernate until the nuclear winter is over. If you're not cash flow positive, you then have to go into the capital market, and you're going to be at the mercy of whatever the capital market conditions are at that time. You sit down with the management team and you say, how do we get to cash flow positive? Sometimes it's a pretty straightforward plan. Sometimes management comes to you and says, we can't do it. Management comes to you and says, we can't do it. What you do is you look them in the eye and you say, oh, yes, you can. All right, go back and try again. All right? They come back, they say, we still can't do it. You say, you haven't tried hard enough, okay? If after the third time they say you still can't do it, you then ask yourself, what's the minimal amount of capital that we need in order to get ourselves to cash flow positive, and what's our business plan for getting there, all right? Once you understand that, you've got the base case for survival. All right, that's the way I think about companies in the situation that we're heading into right now. What's the minimum amount of additional raise you're going to need to do in order that there's enough oxygen in the tank that you've never got to go back to them? And you need to start planning around that situation as the survival move. Anything north of that, if you can raise more than that, that's going to be a bonus in that kind of an environment. But thinking about minimalist survival strategies when you're dealing with a nuclear winter and anybody who's going to be giving you capital is going to be charging a very high price in terms of dilution, to my mind, that's the practical way to start thinking about it, which has sort of a layer of planning which is more sophisticated than simply saying, what's our cash burn? All right, well, we've got another 8 months. And then we're going to go back into the market and we're going to try to raise, well, no. That's a good way not to be paying attention, drive the car off the cliff because you think we got 8 months before we get to the cliff. No. How do we make it 14 months? How do we make it so we don't even need to go back into the market at all if we don't want to? And oh, by the way, if you can figure out how to change the company so you get to cash flow positive and you don't need the cash, it's then much easier to raise the cash at the terms that you want and under circumstances that will make more sense to you.
So the only thing I would say, Joe, is we're not in a nuclear winter as such.
No, we're not.
I don't think the markets out there are that dire.
Right.
They're not dire. I think that could have been true in the 01 period and possibly a little bit in the 08 period when shortly after the financial meltdown. But I think it's more of a breather at this point. I don't think it's yet dire. I think there's a roughly, if depending on the company, it could be between a 10 to 30% cutback in valuation. But that I wouldn't say is dire.
Ram, I agree with you entirely. But in terms of contingency planning,
yes,
that's always a plan that I want my management teams to have and to know about.
Right.
All right. We never hope to go there. All right. Our cash burns and our run rates, are currently, fortunately higher than we would need if we definitely wanted to get to that kind of a situation. But if you're looking at a company and there's no way that you can get there if you have to, then the risk in that company in this environment is substantially greater than a company that says, we know how to reposition and get to cash flow positive and we can make it through an adverse financing environment almost in perpetuity until it turns.
The other thing that bears stating here is that there's very few companies out there that are active M&A possibilities in that what has happened over the last 10 years with the consolidation, both on the consumer side and on the enterprise side, is there are now far fewer buyers than there used to be before. So for companies that think that the way for them to exit is to go sell themselves to somebody, there's far fewer buyers than there used to be. So that has changed the dynamic. So you cannot assume that somebody is going to buy the company because it is much harder to sell now.
We've got a few minutes left, and I don't want to monopolize the conversation, Ram. Why don't we open it up for questions from the audience? Yes, sir.
Just a question, Ram, from your historical experience when the market goes through a cycle. Like at the top of the cycle, there's a greater demand for assets than supply. Prices are oftentimes priced on a relative basis using relative value metrics. And then once that momentum starts to slow, and you rely upon old school stuff like a dividend discount model or free cash flow multiples, there's oftentimes a huge delta between old price versus new price, and difficult for companies to respond to that. So maybe it's the '01 experience or maybe it's '08, but what's been your experience as how the VC industry evolves in looking at valuation methodologies, how long that process takes to reset, and you mentioned 10 to 30%. How do you get to that number? Well, I just meant that as a rough ballpark. It varies. But to your question, I don't think the valuations are derived that scientifically. I wish they were. I think it's largely a supply and demand question to some degree with respect to the sector, the company, the particulars of that company in terms of their metrics, and also how much of a sort of an aura or frenzy they've created around themselves. I mean, I think if you think about some of the consumer businesses that have been funded, they could not have been funded on metrics because a lot of them don't have even basic cash flow metrics, forget about profitability. So I think they're measured on user growth. They're measured on the possibility of the user growth resulting in a sort of a presumed revenue per user, and then the revenue per user netted out of cost per user could ultimately produce some sort of value, and that's a value 5 years from now or longer. If you extrapolate, you take Snapchat, let's say it's so many 100 million users today. If they get to 1 billion users, here's the value they could have. That's sort of how these valuation models are. So these companies have to grow into their valuations. And the problem with some of the unicorns, and I'm excluding Snapchat from this because they're sort of one of a kind, and so in a way they're a special company. But if you think about the run-of-the-mill unicorn, I say run-of-the-mill unicorn only because there's over 150 of them globally. The challenge has been all of them have been valued based on sort of flawless execution. And rarely do companies have flawless execution. And so many of them are going to need more cash, and that's when the stumble happens, where they're going to have to raise it at a much lower price. And you're seeing that already in a lot of cases where they're going back to raise money, they're not able to raise it at the price they had before.
So one of the phrases that I love that you hear more and more often now is we're going to have to grow into our valuation. That's the polite way of saying we were wildly overvalued at the last round, and we don't want to say that we've come way down, but instead we're going to be growing into our valuation. I mean, whenever I hear that phrase, I just kind of go like, why don't you say, yeah, the price was too high, and now we're paying the price for it.
Exactly.
But the polite way for us to say it here in Silicon Valley is we're going to grow into the valuation. And any other questions from the group? All right, we're at the end of our time. We've just got about 10 minutes for a break before we start up with the new session. I promised you the nicest, most successful guy in Silicon Valley, and I hope you agree I'm not a liar. At least not this one.
Thank you.